Welcome back to CrowdWise Academy. This is Brian. Today, we're going to talk about asset allocation and diversification. Here at CrowdWise Academy, you're currently in Module 2 of the Level 1 course covering investing fundamentals. In addition, we have Level 2 intermediate courses for early stage investing and Level 3 advanced courses that talk about screening deals. An overview of today, we're going to be talking about asset allocation. We'll be using some analogies with poker, how asset allocation is similar to the types of bets you can bet on. Also, diversification, within an asset class as well as among different asset classes. Optimal betting strategies, startups as an asset class, including their characteristics of risk, return, and correlation. And lastly, we'll finish things out with your assignment. The main objective today is to answer the question, how does equity crowdfund investing, for example, Regulation Crowdfunding and Regulation A+, fit into an overall investment portfolio strategy? Last course, we introduced the hierarchy of investor needs, and today we're going to be covering the next level, asset allocation. Remember, it's important to start at the bottom of the investor pyramid and work your way up. To understand asset allocation, it's first important to understand what is a bet. Annie Duke, a former World Series of Poker champion, in her book said that a bet is a decision about an uncertain future. In her book, Thinking in Bets, I came to realize that according to this definition, investing really is betting, as are most decisions in life. When you make an investment, you hope that it goes up in value, but there's no way to know what the future holds. So, what are the different types of bets? Well, if you're in a casino, let's think about the different types of games that you can play. There's poker, blackjack, roulette, or perhaps dice games like craps. Now, each of these games has different rules and different betting strategies. In a similar way, an asset class is a group of investment securities that exhibit similar characteristics and are governed by the same laws and regulations. Much as the game in poker or blackjack has certain rules to learn, each investment asset class also has different characteristics of risk, return, and correlation with other assets. So, think of an asset class as the type of bets that you can bet on. Now, typically, investors put these into two buckets. There's traditional assets, such as equities, stocks, fixed income, like bonds, real estate, and cash. Now, in the alternative bucket, it could have anything from cryptocurrencies to commodities such as precious metals, oil, and agricultural products, perhaps collectibles like artwork, stamps, or coins, and many, many more. The important thing to understand is that an asset class can be represented by each of these blocks, where each one has different characteristics of risk and return. Now, asset classes can even be subdivided further into sub-asset classes. For example, let's look at equity, stocks. It's domestic versus international, growth versus value, large cap versus small cap, even private versus public, as the private markets are now available through equity crowdfunding. The important thing to understand is that the asset classes are really just a group of investments that exhibit similar characteristics and risk. An investor can break it down to whatever level makes sense. With investment portfolios, we see asset allocation playing out in different ways. First, there's something like the traditional 60-40 portfolio, which has 60% allocated to stocks and 40% allocated to bonds. A more aggressive investor might perhaps have an 80-20 allocation, where 80% are in stocks or 20% in bonds. And the list goes on, as the types of asset allocation is very dependent on each investor and their risk tolerance, goals, and timeline. For a very good breakdown of all the different types of asset allocation strategies, check out portfoliocharts.com/portfolios. Just realize that startups are another type of asset class that can now be considered for your investment portfolio. So, why do we care? For example, why don't we just choose the game, such as the asset, with the best odds and double down on that? Well, that's because unlike in casino games, in investing, the odds and rules change over time. In a 2000 study of mutual and pension funds by two economists, they concluded that asset allocation explains about 90% of the variability of a fund's returns over time, and 40% of the variation of returns among funds. The other 60% there can be explained by things such as market timing and taxes. So for investors that don't invest for a living, it's important to understand that asset allocation is one of the best battle-tested methods for making wise investment decisions at your portfolio level. Another reason why asset allocation is important is that no asset class is completely safe. Even so-called risk-free investments like sovereign debt in the US government through treasuries and T-bills has some amount of risk that can't be quantified. Most assets that have the potential to outpace inflation will often see major corrections. Let's take a quick look through the past few decades and see what some of your worst years would have been invested in various assets. As many of you probably remember, global financial crisis of 2008 saw stocks drop nearly 37% in 1 year. Along with them, the real estate housing bubble dropped nearly the same amount the same year. Okay, you may be saying, well, what if I just put it all in bonds? Those are perfectly safe, right? Well, bonds alone in the US dropped 3% back in the year 2005. But when you include factors such as inflation and then the opportunity cost of what that same money would have gained in the market, that works out to be nearly a double-digit loss for bonds. Okay, Brian, well, I know bonds might not be safe, but what about physical assets like gold? Gold is safe, right? Not so fast. Go back to 1981, and gold saw a drop in 1 year of nearly 32%. Okay, you may be saying, at this point, I'm just going to take some cash and shove it under my mattress, and it'll be safe there. Well, remember with cash, there's inflation risk, which means that the purchasing power of cash can go down over time. In fact, in 1979, cash, which you just shoved under the mattress, would have lost nearly 13% in value when you took it out the following year. This just goes to show that one of the benefits of asset allocation is that when one of these has a bad year, generally, though not always, other assets in your portfolio may not be following the same trend or even may be going in the opposite direction. Let's do a thought experiment. One big bet versus many small bets. Let's play a game where we flip a coin. If it's heads, you win 2 times your wager. If it's tails, you lose 1 times your wager. You have a total bankroll to bet of $50. I want you to pause and think, what is the optimal betting strategy? Should you bet it all on a single flip? Or perhaps place 50 individual $1 bets? Well, to analyze this problem, we can introduce something called expected value, EV. EV is basically the sum of all possible outcomes multiplied by each probability. And this is something that you can use when looking at potential startup investments. For example, calculating different probabilities of exit multiples and whether that investment makes the cut for your investment portfolio. So, for a fair coin flip, 50% of the times landing on heads and 50% on tails, let's just look at the example where you win the same amount on heads as you lose on tails. To calculate the expected value, you do 50% of landing on heads times what you would win when it lands on heads, plus 50% times what you would lose when it lands on tails. As expected, you'll see that this comes out to $0. So for a fair quarter, as expected, you'll end up with nothing. For our situation, we have 50% of heads with a $2 win, plus 50% for tails with a $1 loss. Thus, putting in $50 of total bets, we can see the expected value of that $50 of bets should be $25 in net wins. However, it all depends on strategy. And this is something that's critical as well to your startup investments, even if the odds are different than a coin flip. To show you what we mean, let's take the results of different betting strategies and put them into a table. Take a look at the table here. Starting on the left, with one bet, you can see that the wager is $50. You have a 50% chance of winning and a 50% chance of losing. Now with 2 bets, you have a 50-50 chance of winning and losing on the first flip and a 50-50 chance of winning and losing on the second flip. Thus, you have a 25% total probability that you would lose on both flips. Now as it goes higher and higher, remember that you get paid twice your wager when you win, so we can see that with 5 flips, you would actually be able to break even almost 80% of the time and only lose money about 18.8% of the time. With 10 bets, it comes down. 25 bets, you're now almost at a 5% chance of losing money. And with 50 bets, each of those bets being $1, you would have less than a 1% chance of losing money. As you can see, in each situation, you're risking the exact same amount of money, which is just the number of bets times your wager with the $50. and you have the same exact expected value of a $25 net win for that bet. However, the number of bets that you're placing is determining your probability of losing money versus winning money. Thus, as it will be with startup investing, your probability of losing money, even on the exact same bets or assets, depends on the number of bets you make. Even if the odds are different for startups and other investments, this concept is a great analogy to show the importance of spreading your bets and diversifying among the startup asset class. So, let's look at investments as coin flips. For a single coin flip, we can liken that to a single security or an industry. It's extremely risky, as we showed even for a safe asset class, due to something called non-systematic or specific risk. That encompasses all the risks that business could fail. Perhaps the founder dies. What if there's a natural disaster and the headquarters gets taken out? Or perhaps new regulations are introduced to the industry. These futures often cannot be foreseen, but when they happen, it can be catastrophic if that was the only one that you invested in. Thus, the next level of diversification is a portfolio of similar coins. This is analogous to diversification in one asset class. It's less risky for sure. You've basically diversified away some of that non-systematic or specific risk. However, there is still a chance that the asset class can suffer due to systematic or market risk. Systematic or market risk is a rising tide floats all boats or sinks them all type situation. For example, during recessions, nearly all U.S. stocks, regardless of industry or anything else, will follow the trend and lose value. Thus, that's the importance of diversification among different asset classes. Here, if we have a portfolio of diverse coins, even perhaps some foreign coins in there, that's a good example of a portfolio of different asset classes. This portfolio has the least overall volatility, and also it should have optimal risk-adjusted returns due to something called the efficient frontier that we will talk about in a few lectures. As with anything though, asset allocation is only a tool to be used, and it's not the answer to everything. There are some limitations and assumptions. One limitation is that actual risk is not quantifiable. Remember, in all the numbers out there for portfolio modeling and asset allocation, everything is based on historical returns. No one can know what the future will hold, and so it's important to remember that there's always a grain of uncertainty in all these predictions. Next, many asset classes tend to be more correlated than one may think. Even taking a look at something such as REITs, real estate investment trusts, and stocks, there can be more correlation than one may expect between two different asset classes of real estate and stocks. Also, it doesn't give any advice for timing. Asset allocation is something that's generally employed through rebalancing throughout the year, but it doesn't give you exact buy or sell signals, and so an investor should have a good plan or work with their investment advisor to come up with a plan that works for your situation. A side note, a great article here on timing is called Even God Couldn't Beat Dollar Cost Averaging by the author of the Of Dollars and Data blog. This basically makes the case that even if you bought the dip perfectly throughout history, it wouldn't beat dollar cost averaging, which is just buying at regular intervals over the long run. So, startups as an asset class, what can we expect for risk, return, and correlation? Well, based on various studies, we have reason to believe that the potential return could be around 9% to 26% IRR. This is taken from angel and venture capital data. Risk, however, is going to be much more risky than the stock market, looking at around a 30 to 42% standard deviation when corrected for the illiquidity of the private markets. This number is taken from early stage VC data. And lastly, correlation is all over the place. We've seen numbers listed as low as 0.04% from a Morningstar study in the early 2000s of private versus public markets, to as high as 68% for early stage VC. This correlation with public stocks in the private markets can even get as high as 86% for private equity when corrected for illiquidity. Here are the references for the data to read more, and there are a lot of studies out there that have varying ranges, but these numbers come up in many of the studies and are probably a good approximation. It's important to remember, though, that the types of startups and investment strategies vary, and whether equity crowdfunding mimics angel and VC returns and risk is still to be seen. So there's one other thing we mentioned that we haven't discussed, and that's correlation of two assets. Now, when we say correlation, a 1.0 correlation means two assets are perfectly in sync. If one goes up, the other goes up. If one goes down, the other goes down. zero or no correlation is exactly as it sounds. We can't predict what one asset will do based on knowing what the second one has done. And then there's negative 1.0, which is exact opposite correlation. This would be an example of when something goes up, the second asset goes down, or vice versa. So when you look at correlation in terms of your portfolio, think of it as a bunch of raindrops on a lake. Each raindrop is a different magnitude and generates waves, and those waves, as they interact with other waves, have constructive and destructive interference. Sometimes the wave amplitudes will add, sometimes they'll cancel each other out, but overall, the volatility, so to speak, of your portfolio is relatively low. Compare that to a single massive drop that was all of those drops combined into one. It would create massive waves, and so similarly, your portfolio would see a lot of volatility and big ups and downs. We'll be talking more about portfolio theory in a few courses. And just to show an example of inverse correlation, here, let's take a look at SPY, which is the S&P 500 ETF, and the iShares 20-year Treasury Bond ETF, TLT. As you can see, they have a correlation of minus 0.63. Now, when you go down and look at the chart, you can see that that negative correlation implies that generally, though not perfectly, when one goes up, the other will go down, and vice versa. So they're moving in opposite directions. This can be a benefit to have in your portfolio since it reduces overall volatility, but you'll still get the benefits of the annualized returns. Here's a one-year chart showing the SPY versus TLT. As you can see, sometimes they track in the same direction, but there are also some big movements in opposite directions. For example, after October 2018, stocks started taking a big dive, but you can see TLT actually went up in value. Then when stocks recovered, TLT stayed straight. Now this type of information is not going to be available for your startup investments, but the key concepts of correlation and how it correlates with public and private markets is going to be applicable to your investment strategy. So when we look at correlation across different asset classes, here are some examples of what you can see. We're not going to spend a lot of time on this chart, but take a look at the last line, which was constructed from Cambridge Associates Index data from 2001 through 2014. Compared to the Russell 1000, it had a 0.68 correlation, that's the private market, versus the public market index, the IWB Russell 1000 ETF. It also had a 0.22 correlation with VGSIX, which is real estate, and a 0.2 correlation with long-term treasuries. Here's the reference for the data, definitely check it out, and also portfoliovisualizer.com is a great tool for getting asset allocations and planning out your portfolio. So let's recap what we've learned today. We've covered diversification, which is used to mitigate specific risk, and the concept of placing many small bets versus one large bet. We've covered asset allocation, which helps to further reduce risk and overall portfolio volatility. We've discussed startups as an asset class, including potential risk, reward, and what the correlation may look like. As you may know, my background was in aerospace mechanical engineering, and I'm a huge fan of Neil deGrasse Tyson. There's a quote of his where he says, "So what is true for life itself is no less true for the universe. Knowing where you came from is no less important than knowing where you are going." We're going to take this quote today and apply it to your investment portfolio. So your assignment for today, before going to the next course, is to figure out your current portfolio allocation. First, figure out the total amount you have invested, with or without retirement accounts, but don't include your house. Try and figure out the percentage of each asset class that you own. How much is in stocks, bonds, real estate, or other investments. And then determine how much would you like to allocate to regulation crowdfunding, equity crowdfunding investing. If you need a refresher, you can go back to the Level 1 Module 1 courses where we talked about some of the Reg CF limits and recommendations from angel investors. However, most angels don't recommend investing more than 5 to 10% of your total investment portfolio in startups because of their high-risk nature. As always, if you have feedback, please post comments with questions, and for technical or other feedback, reach out to me, Brian at crowdwise.org. All right, once you calculate your portfolio allocation, head on over and take the next course. We'll see you back here at CrowdWise Academy.